When I choose which underlying stocks and ETFs to sell puts on, I go beyond the arithmetic and look for opportunities following some basic rules in plain English. These are not absolute rules, but instead preferences if you only have the ability to trade options on a few stocks ETFs per week. When I sell puts, I see myself as an insurance company. I sell puts to people buying insurance for their stock portfolios and occasionally a speculation. Before I do so, I assess risk. I start with the duration of the options. I rarely sell monthly options, and then only in the last week of the options month. I like to avoid what to me is a painful wait for 4 or 5 weeks for not much gain, and instead take advantage of the final 5 days of time decay. With Friday expirations, I also eliminate weekend risk when news happens and I'm powerless to adjust my positions. I like to start with a clean slate every Monday. Also, options with expiration dates every week give you more opportunities, more Fridays to trade. Securities with options expiring every day, 3 times a week or 2 times, are great also, but usually the return makes it less worthwhile with time decay happening too quickly. Focusing on options that expire that week on a Friday is not just about weekend risk. It also keeps the trader engaged and interested. Plus, as the trading month drags on, anxiety is more likely to creep in and poor decisions are more likely. Narrowing down our search further, we prefer options with high trading volume. They have better pricing with their smaller bid-ask spreads, and it's easier to close a trade quickly with those spreads and the high liquidity. Companies and ETFs with more appeal to investors mean more options volume. Usually these companies and ETFs have weekly options, but sometimes they also have options that expire 3 times a week or even daily, depending on how popular they are. Options for certain securities I avoid. For instance, those that are more likely to surprise the market with unexpected news, like the scary with no warning share sales and or added debt. These are difficult to anticipate, but some companies are more prone to financial surprises than others, and ETFs are not directly affected. I also avoid any company that has been accused of or suspected of financial irregularities. When building my weekly put portfolio, I follow a similar strategy from week to week. To start off with, I diversify. I spread out my bets among different industry sectors, although I have certain favorites, like commodities. About a third of my portfolio consists of options on ETFs, including directional ETFs, meaning there might be one ETF that goes up when the semiconductor industry goes up, another one that goes down. So I'll do a little bit of each. Another favorite of mine is investing in an industry sector that is closest to its natural value floor. Artificial intelligence right now is tempting. You can get big premiums, but the fall could be catastrophic. Even if I have strong positive feelings about a particular industry sector, I will devote no more than 20% of my put portfolio to it. One of my guiding investment principles is that nobody knows anything. That includes me. Don't concentrate your holdings because some expert overestimates their knowledge. As with industry sectors, I prefer companies with natural limited downside. Downside risk is important in case of disaster, of course. A company like Ford is less likely to suffer a 90% loss in the next months than a speculative artificial intelligence stock. Ask yourself, what is the floor for the underlying stock or ETF? If you get assigned, you're stuck with it, and the stock reaches that floor, how certain are you that you can sell covered calls and eventually recover? Try to choose companies that have a history of rebounding from down periods. I'll use Ford as an example again, but there are hundreds of other companies with options tied to them that are solid. But some companies, more than others, are too important to the economy and too big for them to fail. I especially like commodity companies with a regular revenue stream. Yes, their options at the money are less appealing, but we're only looking to pick up a penny or two per contract in our strategy. Many option sites focus on charts and technical analysis. We don't do this. People will look at charts and see, in retrospect, what seems to have happened. Looking forward is murkier and ultimately useless. Instead, I look at the trading range for the previous year, which gives me a rough idea of what I can expect in the next week. Although I don't use technical analysis for long-range options trading, I do like to look at the trading range for that day and the current day chart for the underlying to see if the price has plateaued enough to make it safe enough to trade. This is not for early morning trading, of course, but rather for later in the day. No matter how careful we are, disasters will happen and positions will bust. A slow descent becomes a quick descent when a company's viability is threatened. So I get out. I admit defeat. However, if I think the underlying company is in decent shape and will recover, I'll accept the assignment, own the stock, and sell covered calls. But before I make that decision, I look ahead. I look at call options expiring 1 week later to see if they're paying enough that I can make my money back, trading at the same strike price or maybe even a lower strike price. When I am in the position of now owning a stock, I will sometimes sell calls at a lower strike price than that at which I was assigned just to reduce risk. I won't make as much money on that, but it's worth it to me. Timing is another factor when I look at underlying securities. On the final day of an expiration period, for weekly options at Friday, I tend to focus on riskier options that I avoided earlier in the week. As I discussed in another one of our videos, timing is especially important to a big part of our strategy, which is selling puts immediately after the underlying stock has an earnings announcement. These announcements almost always happen Monday through Thursday, and I like to buy back the puts before busy Friday afternoon trading. Please see that video, When to Sell Options, for specifics of this strategy. The same principles I already brought up apply here. If you see a company just released earnings and guidance, and you're tempted to jump in, ask yourself how familiar you are with the stock. Have you seen its trading tendencies over a period of time? If the stock is completely new to you, wait until another earnings period to act. You don't need to be an expert on the company, but get a sense of the rhythm of it first. Another part of our strategy that is impossible to anticipate in advance is that some stocks for a period of time will consistently have unlikely, meaning good, put prices near the end of the day Friday. They look too good to be true. Recently, a relatively unexciting pharmaceutical company selling at about $8 a share had a 1 cent buy bid listed at a $7 strike price, just minutes before the market closed. This same underlying stock had similar price anomalies for 4 straight weeks. So I seized the opportunity and sold more than my usual quota of puts. You will notice such anomalies when you go through your watch list near the end of the day Friday. Yet another reason that the final hour before expiration is so important to our success. But enjoy it while you can. Usually these gifts last a few weeks at most. One more thing to avoid are long chain options, meaning higher price stocks with many strike prices in a row with the same bid-ask spread, especially 1 cent, 2 cents. It takes a long time to clear the many 1 cent, 2 cent strike prices, and 1 cent isn't an attractive return for the higher price stocks that are more likely to have the long chains. Once you have narrowed down which securities to focus on when selling puts, get to know them better. Familiarize yourself with 50 or more companies and 20 or more ETFs. Put them in a watch list. Get used to the rhythm of the stock and follow the news for it, especially the earnings calendar. On the weekend, make a list of stocks reporting earnings that week. Of course, don't trade them before the earnings announcement happens. Trade the next morning if earnings come out that afternoon, or later that morning for earnings released before the market open. Make sure you subscribe so you don't miss the many more options trading tips to come.